Welcome everyone. My name is Dimpo Masamola, and today we will be covering process costing with joint and byproducts. In the previous chapters, when we were looking at the cost, specifically job costing, we said the job cost is the list of all accumulated costs for a specific job. Joint and byproducts are a self-study topic at FITS, but what they entail is that the joint cost is the accumulated cost. These costs are each apportioned or allocated to their relevant departments using the physical measure method using units. This is the method we use in second year. The byproduct is incidental to the production process. For example, in the production of yogurt and milk, cream is considered to be a byproduct. This byproduct can be sold at a selling price that is insignificant to the actual selling price of the intended products. The total selling amount of the incidental product is then used to reduce the total joint cost. Let us now look at an example. Actual production is yogurt with a selling price of 20 Rand per unit. Cream is the byproduct amounting to 10 units. Total costs amount to 100,000 Rand. The cream can be sold at 3 Rand per unit. Therefore, the byproduct is the cream. The sales of the byproduct amount to 30 Rand, and therefore the total joint cost is 100,000 Rand less 30 Rand, which comes to 99,970 Rand. This net cost of 99,970 Rand will be allocated to specific departments using the physical measure method. If we compare the selling price of the cream to that of the yogurt, we establish that it only makes up 15% of the yogurt's selling price. This is calculated by dividing the cost per unit of the cream by that of the yogurt. This shows that the selling price of the byproduct is insignificant to the actual selling price of the intended product. We will now be moving on to process costing. With process costing, we are trying to value inventory. Process costing is used when mass production of similar products takes place, where costs associated with the individual product cannot be identified. Production often takes place in a continuous process. At the beginning of the production, labor, material, and overheads are added. As we produce the product, we incur losses, normal losses and sometimes abnormal losses. Normal losses are the losses that we expect in the production. Additionally, what we need to check in the scenario is whether the normal loss product can be sold at a scrap value. If it can be sold at a scrap value, then we reduce the material cost with the total selling amount of the normal loss. Abnormal loss is the loss that we do not expect to occur in the production process. When approaching a process costing question, we must have the following steps in mind. Step 1. Draw the process line. This will help to identify at which point you are adding which inputs. Other factors to consider when drawing your process line are: what is my opening work in progress percentage? What is my closing work in progress percentage? And the percentage given of opening and or closing stock should be in line with the process line. In other words, 10% should be drawn earlier in the process line than 20%. At a second year level, the inspection point will only occur at year end, so you need not worry about the inspection occurring during the period. Step 2. Perform a unit reconciliation. Very importantly, the unit reconciliation is in units and not amounts. We do a unit reconciliation because we want to get the abnormal loss or abnormal gain. This is performed with the following formula. The opening work in progress plus input less closing work in progress less normal loss will give us our expected completion. This expected completion less the actual completed units will give us abnormal gain or abnormal loss. If the expected completion is greater than completed output, we will have an abnormal loss, which we will add to the CPU table, otherwise known as the cost per unit table, elaborated on later. If the expected completion is less than the actual completed output, we will have an abnormal gain, which we will subtract from the CPU table. Step 3. Do the cost per unit table, otherwise known as the CPU table. Identify from the scenario if you are using the FIFO or the weighted average method. For the FIFO method, we only want to value costs that were incurred in the current production process. For the weighted average method, we want to value opening work in progress costs, completed units costs, and startup costs. We only apportion the closing work in progress for conversion because it is assumed that it hasn't been affected by labor yet. This is why we apportion it according to its percentage completion. Finally, we have step 4, the valuation of completed units and closing work in progress. We will now be looking at additional concepts and exam technique. Normal losses form part of the cost per unit, while the abnormal loss is treated as the period cost. We add the period cost in the table because we want to remove it, as these costs do not form part of the costs incurred in the production. If we say normal losses are part of costs, that means on the valuation of completed output, we need to add back the normal loss, and on the valuation of the abnormal loss, we need to again add the normal loss. We allocate it using the unit of each over the total expected completion. This is 10% of input. Given the scenario does not have opening work in progress and or closing work in progress, the normal loss will be 10% of input. In other words, 10% multiplied by the input value. However, if we are given the opening work in progress and or closing work in progress, then the normal loss is calculated as follows. Opening work in progress plus input less closing work in progress multiplied by 10%, or whatever percentage the scenario has given the normal loss at.